The closing bell rang exactly 15 minutes ago. It is the evening of Thursday, June 25, 2026. The blue chip Dow just surged over 310 points.
Right, crossing 52,000 for a new record.
Exactly, up 0.61%. But the S&P 500 finished virtually flat, up a microscopic 0.04% to 7,361.03. And then you look at the tech-heavy Nasdaq.
Yeah, that was wild.
I mean, it opened with a massive 2% gap up, right, off this historic earnings beat, only to reverse violently and tumble right into the red.
It's a classic intraday head fake.
Yeah. So we're looking at this deep dive into the closing prints, a stack of institutional strategy desk briefs, and the order flow data. We want to decode what the smart money is actually doing into this close. Because on paper, it's a calm summer session.
Oh, but it is anything but calm.
Right. Beneath the surface, this violent great rotation is tearing through portfolios. So let's unpack this. If tech had such blowout earnings news this morning, why did the broader market participation just completely evaporate?
Well, you have to look at the volume, or, the complete lack of it. It's a volume vacuum. The S&P 500 crossed the tape at just 970.76 million shares today.
Wow. Barely under $1 billion.
Exactly.
Yeah.
And just to put that into context for you, Wednesday's volume was 5.99 billion.
That's a massive drop-off.
It is. And when you have this low liquidity distribution regime, the market is incredibly vulnerable to these wild intraday swings. Institutions were aggressively fading the rally today.
So they were using that positive pre-market news as, exit liquidity.
100%. Big money didn't buy that morning gap up at all. Order flow trackers logged a massive negative $796.1 million net sell imbalance.
Man, into the close.
Into the close. The actual sell volume pressure outpaced buy volume by 11.8%.
Yeah.
So if we connect this to the bigger picture, this was not some high conviction breakout.
Right. It's the smart money unloading. Like the S&P is a duck on a pond,
Right.
Gliding smooth on top, just flat, but paddling frantically underneath.
That's a great way to put it.
Because we have this historic divergence inside the tech sector itself, and that brings us to the core conflict, Micron Technology, ticker MU.
Yeah, an absolute monster Q3 beat.
Pre-market, they gap up 16%. They printed $25.11 in earnings per share on $41.46 billion in revenue.
Unbelievable numbers, but it was the guidance that really shook things
Yeah,
up.
right. A $50 billion Q4 revenue forecast. And that's fueled by $22 billion in locked-in customer commitments.
The hyperscalers have their checkbooks out,
Yeah, so MU closes up around 14%, right? But then Apple drops nearly 5%, dragging down the rest of the Magnificent Seven.
Yeah.
Wait, so AI hardware is booming, but consumer tech is crashing. I thought AI was supposed to lift all tech boats. How is Micron's success actually hurting Apple?
Well, this is the core micro-divergence of 2026. What's fascinating here is that Micron's pricing power is literally eating Apple's consumer margins.
Oh, because of the memory chip.
Exactly. The AI data center land grab requires so much high bandwidth memory, and Micron controls that choke point. The cost of memory is just skyrocketing.
Which means if you build laptops or tablets,
Your supply chain costs are suddenly astronomical. Apple had to announce immediate price hikes today.
Yeah, the budget MacBook Neo jumped from $599 to $699, $100 overnight.
And Apple explicitly cited the, quote, unprecedented cost of memory chips.
Right.
The market is violently demanding near-term margin proof right now. The soaring cost of AI infrastructure is basically a penalty for these consumer-facing giants.
So the smart money sees Apple's margins getting squeezed and they just dump the stock.
Exactly.
Okay, so what does this all mean for the capital that's actively fleeing these bloated mega-cap consumer tech names? Where's the money going?
It's rotating. It's a highly selective picks and shovels trade right now. Capital is hiding in physical infrastructure.
Right, the industrials and financials.
Yeah. First, look at the casualties. Palantir suffered its 7th consecutive down session.
Closing at $108.46.
Lowest since April 2025. But then you look at Caterpillar.
Surged 4.4% today to all-time highs.
And Qualcomm jumped 6.9%.
Because they doubled their fiscal 2029 non-handset AI revenue target, right? Up to $40 billion.
Yeah, and they announced Meta is adopting their new Dragonfly C1000 CPU. Qualcomm is successfully diversifying away from mobile.
Which is key because they're dodging that consumer margin trap.
Exactly. So if you're out there blindly buying cap-weighted index ETFs right now, you are getting heavily diluted by that massive tech cap drag.
Because Apple and the mega caps make up such a huge percentage of the S&P.
Right. You're holding the bag on their margin compression.
Okay, so the sector rotation makes perfect sense on a micro level. Sell software, buy hardware and concrete. But we have to look at the macro ceiling here.
The inflation picture.
Right. The broader anxieties keeping traders so defensive. Let's look at the SIBO Volatility Index, the VIX.
The sticky VIX.
Despite the Dow's rally and the S&P closing green, the VIX actually rose today, plus 1.02% to 18.82.
Establishing a really firm floor right there near 18.
Which is basically like buying expensive fire insurance while your house is actively going up in value. I mean, oil prices are easing. Brent crude slipped to $73.74 today because the Strait of Hormuz cleared.
Right.
So if oil is down, why is Wall Street quietly loading up on portfolio insurance?
Because of the PCE data. The May PCE inflation data printed at a sticky 4.1% annual rate.
The highest since April 2023.
Exactly. And even though it matched consensus, it keeps the Federal Reserve's rate cut hopes completely frozen. I mean, strategy desks are actively fueling bets for a second rate hike by year end.
Wow. A second hike.
Yeah. This raises an important question about institutional trust. When the VIX rises on a green day, smart money isn't buying this whole inflation has peaked narrative.
They're hedging for a deeper shakeout.
They know the liquidity is thin, so they are locking in downside protection.
Which brings us to the Friday setup. We have mapped out the macro fears and the micro rotation. Here's where it gets really interesting. What should you watch for when the bell rings tomorrow?
Well, first thing is the final University of Michigan consumer sentiment print.
Right, to see if the falling crude prices are cooling those inflation fears at all.
But tactically, the institutional playbook for Friday is all about one critical battleground level, 7,350 on the SPX.
Okay, 7,350, and that lines up with the 50-day moving average, right? Which is 7,349.
Precisely. The options market is implying a massive asymmetric setup here.
So break down the mechanics of that. What happens if it breaks?
If 7,350 breaks, dealers are forced into rapid put hedging. You can expect a fast flush down to 7,276.
Wow, okay. And if it holds?
If it holds, we squeeze to 7,440.
So it's very binary.
Extremely. But beyond the index, you need to watch these day two momentum setups. There's a 70% continuation probability on the desks for these specific names.
Like Micron.
Exactly. Watch Micron for an opening range breakout. If it holds its post-earnings gap and establishes support, that's a prime day two play.
Because institutions that are underweight MU are basically forced to buy to catch up to that $50 billion guidance.
They literally have to. And the other one is Qualcomm. That is a pure CapEx breakout right now.
Awesome. So to summarize, the index is just a mask right now. We are in this choppy and neutral sandbox where macro data is just way too hot for the Fed to ease.
Yeah, totally frozen.
But corporate earnings in AI hardware are too strong for a true bear market.
That's a tug of war. But I want to leave you with a final thought to ponder here. Right now, all the money is being made in the picks and shovels of AI infrastructure, right?
The chips, the data centers, the energy required to run them.
Exactly. But what happens to the global market when this massive infrastructure build-out is finally complete?
When the concrete actually dries.
Yes. When these companies actually have to deliver end-user consumer software profits to justify the trillions of dollars they just spent. If a $100 price hike on a laptop is crashing Apple today, how does the consumer pay for all this AI tomorrow?
That is a massive structural question to chew on. All right, thank you for joining us for this deep dive. Keep your risk tight as you head into Friday's session, respect those gamma levels, and we will catch you after the bell.